Hello and welcome to the Week in Markets. I'm Paul Durrans and I'm joined by Sam Elliott, our investment analyst here at True Potential. I suppose, Sam, it's been a fairly busy week for stock markets in terms of economic data as well. We have seen a bit of consolidation across stock markets, although we're looking to new highs today. I suppose China has been one that's been grabbing the headlines over the last couple of weeks, and their stock market has really pushed materially higher following the announcements of greater fiscal and monetary stimulus. I suppose, Sam, we've seen that the Chinese stock market this week has been having a holiday, a public holiday. So has there been any further considerations in terms of how the market's digested the stimulus measures?
Yeah, that's right, Paul. So as we discussed on the videos last week in great depth, we saw those stimulus measures come through in China as a way of trying to boost economic activity within the country, particularly focused on the property sector, which has been in a bit of a slump over the last 2 years or so. Yeah. As you say, China reacted very strongly in terms of equity markets last week. Has been closed this week for a national holiday, but the Hong Kong market, the offshore market's been open, and that's seen the rally continue. So we've had double-digit returns again this week within the Hong Kong market, and really being driven by those property names which have struggled over the last couple of years, but seen really strong returns over the last couple of weeks.
And I suppose some of our managers have been leaning into emerging markets given the valuation discounts, and that's really been paying off over the last couple of weeks. I suppose what's quite interesting is that we haven't seen the spillover effects into broader emerging markets from China, but there have been other assets that the portfolios are exposed to that have benefited.
Yeah, particularly commodity markets seem to have reacted to the news as well, particularly looking at industrial metals, which will be reacting to those stimulus measures. So the likes of steel, the likes of iron ore, really strong growth within those commodity markets.
Super. So if we move away from the second largest economy in the world to the first, the US, where we've seen last month interest rates being cut for the first time in this interest rate cycle, down 0.5%. I suppose the Federal Reserve have been talking or have been more sanguine on the inflation dynamics and really focusing more on the economic growth, and in particular the labour market, where we continue to see normalisation from very tight levels. I suppose this week, today even, we've had quite a number of different labour market or employment statistics that the market's been really focusing on. What have we learned?
Yeah, that's right. So really just highlighted the ongoing strength of the US jobs market. So non-farm payrolls were released today. That looks at the number of jobs which were added to the economy over September. We saw that come in at just above 250,000 jobs added, which is about 100,000 more than was expected. So a really strong number. We also saw the number for August revised higher, so more jobs added in August than was previously expected. And also we've seen the unemployment rate fall for the second consecutive month. That's actually been trending higher for much of 2024, but it's ticked lower over the last 2 months. So really tight labour market still, has been normalising, but really ongoing strength.
And I suppose it may just push back on market pricing in terms of where interest rates may get to over the coming months. I suppose before the reading, expectations between now and the end of the year was looking for a 50 basis point cut or more before the year end. The market will be starting to price that out because it appears, based on the economic data that we've seen this week, and as Sam, you just talked us through, the labour market remains strong, the economy remains resilient, and therefore the need for lower interest rates may be further down the road.
Yep.
Super. So if we move from the US now to Europe, I suppose a very different picture when we think about Europe's economy, not necessarily their stock market, where we have seen new all-time highs last week in various parts of Europe, but in terms of economic data, inflation, interest rates, what are the considerations there?
Yeah, it's a bit of a mixed picture, like you say. So the bright spot is really the services side of the economy.
Yeah.
Remains, if we look at the survey data, that remains positive, although less positive than, say, in the US. But the manufacturing sector remains in contraction, so that's really the concerning part there. Unemployment remains historically low, which is a positive. Lots of people employed, supportive of economic activity. But the inflation data is also being key this week as well, and we've seen actually the inflation number month on month in September was actually negative 0.1, so prices were lower in September than they were in August. And that led to the headline inflation number being 1.8%. So that's actually below the ECB's 2% target. That was the first time since 2021 that's came in below target. The other bit to look at was just core inflation, which takes out the most volatile components. That's still been trended lower, but it's been a bit more sticky, but it's on the right path. So all of these considerations for the ECB in terms of their interest rate setting policy.
And I suppose, as you point out, that European economy has been a bit more downbeat. Inflation is undershooting where the European Central Bank believe it should be, and would suggest that the ECB need to cut interest rates perhaps faster than they have been communicating in recent meetings. So we've certainly seen that in market pricing over the course of the week. Let's turn closer to home. Thinking about the UK, sterling has been falling quite a bit over the last week after several months of sterling appreciation, particularly against the dollar. We've seen a bit of a reverse of that. Why is that?
Yeah, that's right. So, like I say, we've had a really strong sort of 6-month period for the pound, particularly against the dollar. There was expectations that the Bank of England would lower interest rates slower than you get in the Federal Reserve in the US, and that was giving the pound support. This week we had the Bank of England Governor, Andrew Bailey, in an interview. He mentioned comments around the potential for interest rates to be cut more aggressively, and the pound reacted to that. So we saw a significant weakening of the pound against both the dollar and also the euro. I think it was the single worst day for the pound in 2 years. But actually the Bank of England today came out to try and pare back those expectations. So we had the Bank of England chief economist Hugh Pill warning around cutting interest rates too fast or too far, really just to pare back those expectations. And also just talking about the need for policymakers to be aware of what's going on within the global economy, the risks to that, for example, a higher oil price.
Yeah, and I suppose just let's finish with oil prices, where we've seen a significant increase over the last week, up around 9% on the week. And that's really driven by the conflict that we've seen within the Middle East between Israel and Iran, and that's ongoing. I suppose it's been fairly well contained within markets. It's only really seen a noticeable change within the oil prices. Equity markets have been relatively unaffected, as have bonds. But I suppose this is part of the reason why we emphasise diversification for these times of uncertainty and unrest, which there always are, unfortunately. It's important to have a well-diversified portfolio to try and smooth out some of this volatility that comes through. Thank you, Sam, and thank you all for watching. That's all from us today. Have a great weekend, and we'll see you on Monday.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.